All right, let's say you want to get started with investing in the stock market, or maybe you've been investing in the stock market, but you're frustrated or anxious because you don't really know what you're doing. We hear about these companies on the news like Tesla, Apple, or Amazon, and then a friend is saying you should buy this or that stock because it's supposed to do really well. So you start doing research and you find all these acronyms online getting thrown around like 401ks, Roth IRAs, ETFs, and in the end, this all just creates more anxiety because we all know investing is risky and nobody wants to lose their entire life savings. So this video will be an investing guide where I will address how to start investing for the long term and how the market actually works in small bite-sized steps. So by the end of the video, you'll have way more insight and confidence on how to take advantage of the market and invest going forward. So the first one has nothing to do with investing, but understanding how inflation impacts the value of our money. Because of inflation, the value of our money decreases over time. As an example, a gallon of milk back in 1995 was $2.48. In 2022, it has almost doubled to $4.82. If you have $10,000 and stuff it under your mattress for the next 10 years, while the inflation rate is 3%, you're technically losing 3% on your money every year. Now, let's say you put that $10,000 in a bank account getting 1% interest. You are still losing the value of your dollar because the 1% interest is below the 3% inflation rate. This is why folks start investing, whether it's in the market or real estate, because over the long term, the stock market statistically goes up. Here is a zoomed out perspective of the S&P 500, which is an index that represents 500 of the top publicly traded US companies from 1996 to July 31st of 2023. In this chart, you'll notice inflection points where the market goes up and down. Now, if you remember, when COVID took place, we had one of the fastest stock market drops in history. In that moment, the market was collapsing. From February 19th, 2020 to March 23rd of 2020, the S&P dropped 34%. Back in 2008, it dropped 57%. Many of us, I'm sure, still remember this, but what we don't realize is every year the market goes negative, it doesn't mean it will end the year negative. For 2020, even with the negative 34% decline, we ended the year positive, up 16%. Now, every year is not positive, but when we look at statistics, even though in a given year the market averages a drop of negative 14.3%, annual returns were up positive 75% of the time. So the key takeaway is volatility, meaning the ups and downs in the market is normal. While the pullbacks cannot be predicted, they can be expected. So we know over the long haul, the market tends to go up. We also know the market can drastically go up and down within any given year. So what is the best way to invest in the stock market? And honestly, it depends on many factors, including your goals, how long you want to invest for, and your comfort level with taking risk. Because even though the market statistically goes up over the long term, many individuals cannot stand seeing their investments go up and down day to day, month to month, or year to year. So here are several ways you can invest in the market. The first is simply buying shares in a specific company. So you can go online to Charles Schwab, Fidelity, TD Ameritrade, Interactive Brokers, or another online brokerage trading platform, open up an account, deposit your money, and you can buy stocks. So for example, let's say Apple is trading at $100 per share. That means in order to buy one share of stock in that company, you can buy it for $100. If you wanted 5 shares, it's whatever the stock price is at that point in time times the number of shares. So $100 times 5 shares is $500. Now, the risk with this is that your investment is solely based on the performance of that one company. So understand, it will go up and down, some days more than others, every single day. And some people are completely okay with that, and some are not. Another way to invest is buying an index fund, otherwise known as ETFs or exchange-traded funds. All this means is that rather than buying and investing in one single company like Apple, you instead buy the entire index, which for the S&P 500 is made up of 500 companies, or the Russell 3000, which is made up of 3,000 companies. And for each of those index funds, there's a fund manager that usually charges an underlying fee for them to pick the stocks within the fund and manage it for you so you wouldn't have to worry about it. Now, some of the mindsets that I've heard over the years is that investing is scary. You can lose all your money in the market. But if you think about it, the only way to lose money in the stock market is if you buy something and sell it for less than you bought it for. Unless you put all your money into one company and that company goes bankrupt, then you can lose everything. It does happen. But if you stick to buying an index, the chances of 500 companies going bankrupt all at the same time are rather slim. But here's what I see all the time. Someone buys the S&P 500 and then it starts to go down. After a week, it starts to come back a little bit. Then it goes back down. And after a month or two, they sell it because they're not making money, which locks in a loss, losing money. And they say, don't invest in the stock market, you'll lose all your money. Well, selling it was the reason you lost your money. If you held on to it for another year or two, you could have made your money back, plus some. So the lesson is when you're investing in the market, these are long-term investments that ideally you don't want to touch for at least 5+ years because it takes time. They will go up and down, but if you stay in the game long enough, you are more likely to make money on the back end. Now, I completely understand when the market is going down and you pull up your retirement account online and you see it's entirely in the red. There's a knee-jerk reaction to wanting to get out because you don't want to lose your money. The problem with this is 7 of the 10 best days in the S&P 500 between 2003 to 2022 occurred within 2 weeks of the 10 worst days. So 7 of the best trading days when the market had its best returns occurred right after a huge decline in the market. This is why planning to stay invested is so important. The second worst day of 2020, which was March 12th, was immediately followed by the second best day of the year. If you sold on the way down, you would have completely missed the entire upside. So how do you get started investing? It's as easy as Googling best online broker. You create login information and fill out some online forms to set up an account. You can link the account to your bank, move money into it, and then start buying stocks or index funds or whatever you'd like. Just make sure you can invest in index funds and that the fees are low. Now, for many online brokers these days, trading is free, so it can almost cost you nothing to do this. Now, if investing your life savings and doing this on your own sounds like too much, and you're a business owner, we can potentially help you. Check out the link in the description to our website and see if we'd be a fit to help you out. I hope this video was helpful for everyone. Please subscribe and I'll see you in the next video.